What's up, guys? It's your boy Outhenticfx here, and we are back with another video. This is episode 2, and I want you guys to know that we are grateful to have you here. Thank you for all of those who watched episode 1. Please drop a like, comment, and don't forget to subscribe, guys, as this is the May 2023 Premium Mentorship Program, Mastering the Art of Smart Money Trading, guys. So let's get into it. So, guys, please don't forget to drop a comment in the description. Tell us how you feel about the previous episode. Tell us what your expectations are for the course ahead. And just give us, your thoughts on any ideas, anything that you think we did right or wrong. Let us know, guys. I mean, this is a learning space, guys. We are all here to learn. I hope you are enjoying the content, though. And just to recap from what we spoke about yesterday, guys, I just want you guys to always remember that whenever we start analyzing any single pair or whatever the case is, we need to start off on the higher time frames and work our way down. And that's what today's lesson or episode is going to be about. Today's lesson or episode is going to be about the essentials to analyzing the weekly and daily bias, guys. This is the most important factor when it comes to elements of a trade setup, guys. I hope you have your notepad out and your notepad, and just have notes, guys. Write down your notes. I do also have mine with me as we speak, and I will be just referring back to a few things. And yeah, guys, let's get into it, guys. So to start off, we do have the following, right? We need to predict or anticipate whether or not the next daily weekly candle will be an up close candle or down close candle, guys. So that is the main question when we start off on the weekly and daily time frame. We need to identify the following, and that is: where is price most likely to gravitate to? The draw of liquidity, right? We need to understand and identify the draw of liquidity and ask ourselves also, what phase are we in? Are we in a ranging market on the weekly, on the daily time frame? Are we bullish or bearish? And then from there, we need to implement institutional order flow, guys. And for these examples, I will be using the Japanese yen index, which is here to the top corner, and the USD JPY currency pair, which we did use in the last example. We will be building on our previous lesson and just basically going deeper into price and understanding what defines and what creates these moves, guys, in the market. I also want you guys to understand one thing, guys, that even though we are learning the daily and weekly bias, it does not mean we will be able to predict every single daily move or weekly move. And that is okay, guys, because as long as we can pinpoint certain key things within this module, we'll be able to catch those good trades here and there, guys. So what we are trying to do here is basically predict the likelihood of the daily candle or weekly candle being an up close candle or down close candle, and seeking that draw in liquidity. So let's start off on the question of where is price most likely to gravitate to. So where is price most likely to gravitate to? So the question we ask ourselves is, obviously we know that price always gravitates towards liquidity, guys. So that will be our draw in liquidity, right? So the question is the next candle on the weekly time frame expanding higher or lower? So to the left, we have our yen index. We can clearly see these candles are expanding to the downside because we are expanding to this sell stops and drawing liquidity within this bullish order block. And as you can see that from this point of view, we can clearly see from price being bearish, we have now expanded to the upside, breaking structure to the left, right, creating equal highs, right, and now we have a minor retracement to the downside. That shows us that price is coming to this draw of liquidity to mitigate these areas, and then from there rebalance any insufficiency in price and continue its expansion to the upside as we are done with the bearish momentum, because we are in a discounted zone. So now we're in a discounted zone, we look to buy price into this premium level, right? Vice versa on the USD JPY pair. The reason why I put these two together is because the yen correlates with USD JPY. If the yen index is going down, that means USD JPY is going up, and that gives us more confirmation in analyzing and anticipating the week ahead or the day ahead and the price action that follows, guys. So note the following: every time we move from a consolidation and start to have an expansion phase, we need to consider where is the draw of liquidity. So we can see we've marked up our draws of liquidity, which is these equal highs, this bearish order block that is unmitigated, this imbalance that we have to the left, and vice versa with the bullish order block, which is this last down candle before this major move up, which broke structure to the left, and the sell stop that resides below. These are all confirmations that price can draw to these areas and then continue its momentum or push to the upside. As you can see, for the USD JPY currency pair, we have these equal lows, we have a bullish order block, we have imbalance to these three candles, and now we can clearly see that price is gravitating to take out these equal highs or mitigate this fair value gap to continue its momentum to take out these short-term lows and mitigate this imbalance or bullish order block. What phase are we in? Are we bullish or bearish? Clearly right now, we can clearly see that from this bearish push, we are pushing up. So we are bullish on the yen index and bearish on the USD JPY currency pair, right? So note the following: once we leave a consolidation and price is bullish or bearish, note the reversal candles or retracements. Those moves fuel the market. Put that down in your notes, guys. That is very, very, very important, because that will help us identify where price is expanding to. So as you can see, we started on this consolidation and had a nice expansion to the upside, and these three candles started reversing, fueling the market to create a secondary expansion and reversing again to create that third expansion, guys. This is part of institutional order flow, guys. We need to know that when price action gives us three consecutive highs, right, as you can see, we've got our first high, second high, third high on a price leg. That is an indication that a reversal is about to happen, guys. It's a three-wave push to the upside or downside, indicates that price is getting exhausted, and at the third wave, expect a reversal. If price happens to create a fourth wave, that means there's a new area or draw of liquidity that it is targeting. So as you can see, we then push to the downside. So for the yen index, we can clearly see we had a nice consolidation within this entire range, creating a minor expansion, breaking structure, reversal, consolidation, expansion, creating that secondary expansion, reversal, creating that third expansion, and a consolidation. From that third expansion to the downside, we can clearly see now we are reversing, and one of two things can happen. We can either take out the draw of liquidity to the low and then push up to take out these equal high and buy stops and mitigate the draw of liquidity within this imbalance and order block. So the next question is, how do we implement institutional order flow into our price charts? That goes as follows. We look at the institutional order flow. The whole idea is to think like the market makers. The market makers always target liquidity. So from this major move to the downside, notice all these buy stops that reside at these highs. Remember, guys, above all the highs is buy stops, above all lows is sell stops, and these are basically our targets. So now we know that we are at our third expansion. We know now that we broke structure, taking out these buy stops. This indicates that from here on, we will be targeting the rest of the buy stops, vice versa with the sell stops, guys. The question that we need to write down or note is, where is the maximum level of liquidity in relation to where markets have traded? So market have already traded here to the downside, and now we have to put into perspective where price is currently. Price has currently broke structure, indicating that a new trend is about to occur. So let's go deeper and go on to the daily time frame. and basically put the daily time frame into perspective, marking down the analysis, right? So the daily analysis goes as follows. When we look at price, we do not just look for a higher high or lower high. We look for reasons why the market has to go up or down. As I said, on the weekly time frame, we are targeting those draws of liquidity, whether sell stops or buy stops, previous highs or lows, imbalance or order blocks, guys. And the rules for the daily buyers are as follows. Once price seeks that draw of liquidity, the first move indicating a reversal or that imbalance on the daily time frame, we mark up the following: long-term highs and lows, short-term highs and lows, and intermediate term highs and lows. So what are we basically talking about? We are talking about the following, right? So we've got our long-term high here, we've got our short-term low here, and then within this expansion and this low, right, we have a short-term low, short-term high, short-term low, short-term high, right, before price breaks out to the upside, taking out this high and this high, which is why price has created that first expansion, second expansion, third expansion. We now see price drawing to that draw of liquidity or gravitating to the upside to take out those buy stops, which you can clearly see, which is why we mark up these short-term lows, because once price reaches a premium level, which we are currently in, notice how price breaks structure to the downside, creating a new expansion to the downside. So this will be expansion 1, retracement expansion 2, and we target these draws of liquidity, guys. So these will be your long-term highs, which are your swing points, your swing lows and swing highs, and then short-term highs and lows will be just price action within these ranges that create the low and the high of the swing point. What is an intermediate term low and high? Intermediate term high is basically a high on we have a overall high, right? And then on either side of the high we'll have short-term highs. Those are your intermediate term highs. And then when it comes to the USD JPY pair, we can clearly see that once we reach this premium level, price then started targeting these areas of short-term lows and gravitating to the downside, creating that first expansion, retracement, secondary expansion, retracement, third expansion, reaching our point of or area of liquidity, taking it out. What is a intermediate term low? Intermediate term low is basically when you have your long-term low, and on either side you will have lows, which you can clearly see, that create a new expansion, creating that new short-term high and low. Guys, when it comes to marking up these levels in the market, we can also just understand one thing, guys. When the market is not trending, the market usually goes back to traditional models of support and resistance. And basically, the question that we need to ask ourselves is, which support do we use and which resistance do we use? So we always look for those key turning points, which will obviously be at our highs and lows. And you can clearly see that from this high, price will then gravitate to creating a resistance once breaking it, and then we push to the upside. Once we break that resistance, we can clearly see that now our next target will be this resistance that created that push to the upside. Notice how once we break that resistance, price then gravitates back into it and then pushes down, holding this resistance point and creating a fake out, and vice versa with price moving and continuing its move, guys. So these areas in the market will obviously relate to traditional support and resistance areas in the market. The aim is to understand how the market moves and how it reacts within a overbought area and an oversold area, right, between the equilibrium point of a specific price range, guys. So just notice how our if just notice the following: are we taking out old highs, are we taking out old lows, and where is price gravitating too, guys. So that is a very key important factor, because without marking up these short-term highs and lows, we won't be able to see where price will most likely gravitate to and where we might target as our draw of liquidity, guys. So that is basically how you mark up the daily bias. But now to get deeper into the daily bias and figure out how can we trade from Monday to Friday, the daily analysis goes as follows. What we basically do is plot the previous day's high and previous day's low and analyze the previous week's movement. So in this case, for example, we'll plot down the previous day's candle and then plot down the previous week's movement, so we know that we are bearish, so we are expecting bearish momentum as price goes forward. So let's put the rules into perspective when it comes into the daily bias, right? So the question we need to ask ourselves, so if the previous day, so let's say Friday's candle is bullish, we look to target the previous day's high, and the low of the previous day must act as support, right? Let's say Friday's candle is bearish, we look to target the previous day's low, and the high of the previous day should act as resistance. Sorry, this should be resistance, guys. Apologies for that error. But anyway, just note the following. Focus on each new day and mark up the high and the low of the candle and follow the bias till we reach that draw of liquidity. If we see price taking out both the low and the high, that shows indecision or that price wants to reverse, guys. I hope you are enjoying the video as we are about to get into the last segment of the episode. Please give the video a thumbs up and don't forget to comment, guys. So as we are marking up our short-term lows when price is pushing down and taking out those short-term lows and draw of liquidity, let's break down how this begins. Let's break down how this either begins on the bearish side and bullish side, because we can clearly see we are taking out buy stops to seek that draw of liquidity. So since we are bearish on GBP JPY index, we mark up the previous week's range, right? So let's say this was Friday, this was Monday, Tuesday, Wednesday, Thursday, Friday of last week. We open up on Monday, right? So Monday prints out a bearish candle, which the previous day, Friday, had a bullish push to the upside, just basically filling the void within the previous week's Friday's candle. Monday opens up, guys, right? The question we need to ask ourselves is, where is the draw of liquidity? The draw of liquidity is at these lows, because notice how we have 3 consecutive wicks, right, rejecting at these lows, creating equal body closures at these lows, showing us that this is a buildup of orders and liquidity is resting. So we are gonna target these lows from Monday throughout the week, targeting for the weekly candle to push from the high to the low to take out that draw of liquidity. And on USD JPY, we have a bullish move, right? And notice that the wicks have been built up on either side. We've got a high, intermediate term high, and intermediate term low, which creates that buy side liquidity or buy stops, which we are going to target to take out on either side. And now what next? We basically marked up our previous days high and low, and notice how Tuesday's candle gravitates to the downside, violating the low but respecting the high, and vice versa with USD JPY. Guys, remember these pairs are correlated and they do work in sync. If one is bearish, the other will be bullish, and you can clearly see that in these examples. So on USD JPY, we've marked up the high and low, and notice how Tuesday's candle pushes up, breaking the high, as we are expecting bearish momentum to gravitate to the liquidity draw or area of interest. So what we do now, we mark up Tuesday's high and low on both pairs and expect price to break the low on the yen pair, so that on USD JPY, when we are trading USD JPY, we are looking for that buy. Look at what Wednesday does. Wednesday opens, gravitates to the downside and clearly breaks the high, pushing up, sweeping that draw of liquidity, confirming our bias for the week. Once Wednesday is in sync, we know that, for example, that the weekly candle from this low to this high will be closing bullish for the week ahead, and vice versa with the yen index. Notice how we violate the low but fail to violate the high, which is in sync because we are targeting that draw in liquidity. So when Wednesday is done, we mark up the low and high on USD JPY and low and high on the yen index, and anticipate a further downside move to take out that draw in liquidity, which we do have here in the yen index, confirming a new break of structure with a bearish close, body and wick candle, which is a very strong confirmation to a new trend reversal. Notice what happens now on USD JPY. We fail to basically take out the previous day's high. We are stuck in that range, but we don't take out the low, which is still valid because this basically shows us that we've taken out the draw in liquidity or short-term high. Price might now start to become indecisive or basically show us a reversal in the week ahead. So as this is Thursday, let's look at what Friday's candle would do. And then obviously we know that if Friday's candle gravitates to the downside, we are looking to fill this void in the market, which is a fair value gap between the high of this candle and low of Thursday's candle, leaving Wednesday's candle with a void. So look what happens, guys. Basically, Friday's candle gravitates down, fill that void, and then from there we can see that this is a reversal. But remember, guys, we've already broke structure to the upside, so all we are expecting now, this is Monday's candle to just carry on to the upside. So this is basically how you mark up the daily bias and follow through from the weekly to the daily time frame, guys. You identify the following. So let's have our checklist in order so that you guys can use this in other pairs and other indices and commodities that you do trade. So remember, we always want to mark up the high and the low of the candle, but also, guys, consider and mark up where the open and close of that candle is, because marking up the open and the close of that candle is also very important, because you'll be able to see how price reacts to the previous day's open and close. And then from there also, don't forget to mark up the draw in liquidity, and institutional order flow is very important. Always target those areas in the market, guys. So guys, this is basically all for today's lesson. I hope you enjoyed it, guys. I just want you guys to remember that whenever we are in the market, we need to always react to what is happening. So this will not always happen, right? As you can see from these examples, this will not always happen. But when we do have these weeks where price does not consolidate and shows us bullish or bearish momentum, we do capitalize off these trades, guys, because this strategy is golden, right? So that is it for today's lesson, guys. I hope you guys enjoyed the lesson, and just basically have your notepad out and just always, guys, please take down notes, guys. And I want to leave you with this quote for today, which is basically, life is 10% what happens to us and 90% how we react to it, by Charles P. Swindoll, guys. Remember that quote, guys. It applies to trading as well. We always react to the market. We don't think, we don't guess, we don't predict, we react. So thank you guys for today's lesson, guys. I hope you enjoyed it. Drop a comment down below. Don't forget to share the videos, guys, and see you tomorrow for episode 3. That is a wrap, guys. Outhenticfx here, signing out.